two sets of minutes that everybody had a chance to look over. Do I have somebody to make a motion to approve?
So moved.
Second?
Second. Second.
On the question, anybody? All in favor?
Aye.
Thank you. Any public? No public here to address the board. Donnie, you have anything to say? So, 25-31, what? Okay. I'll let you introduce our folks here today.
Our longtime representative from CS McKee has retired, Mark Gensheimer, to many grandchildren. Just had another one. And they have been replaced. Well, it's not that he's been replaced, but our new representatives are Shane and Zach from CS McKee, and they're going to be our delegates with CS McKee going forward. So, yes.
We appreciate that. Thank
No
you.
problem. Thank you. Just
Welcome
wanted to give
aboard.
Yeah.
Yes.
Mark has called about 7 times just to make sure everything was okay with him. And he has said that in the first quarter, let's come back again. They're out in San Francisco. They're helping with the new baby. We were just born last week, so he said he'll be back, and I think he wants to get out of the house already with me.
I'm sure, yeah, I'm sure.
I'd like to mention, too, that joining us for the first meeting is my new Deputy Controller, Kim Rose, is here. And thanks, Kim, and everybody knows Reggie.
All right, well, 25-5031 is the performance report, so I'll turn that over to Shane.
Yeah, absolutely. So thank you all. And as Don said, I'm very excited to have Zach with us. Zach's someone I've known for probably the better part of the last 15 years. But before coming to CS McKee, he spent a number of years at Vanguard. So we're very excited to have him. He works out of Philadelphia, so he's nice, a little bit easier drive for him here. But he and I cover the entire state together, as well as a number of other states across the country. So with that being said, if you'll turn to page number 2 of the presentation books, we can get started there. And what you'll see in the upper left-hand corner, if you look at the account statement, it should say as of 9/30. And to be honest with you, it has been a fantastic year so far. As you can see here, year to date, your portfolio began the year with a market value of just north of $215 million. In the first 3 quarters, you had net expenses of about $1.5 million. That's for pension payments and other type of pension-related expenses that are out there. And then you look. Oh, sorry about that. So yeah, the portfolio generated about $28.4 million from the investments in the portfolio. That resulted in about just over a 13% return through the first 3 quarters. And as a result, at the end of September, the portfolio had a market value of about $242.5 million. Now, when you take a look underneath the hood, it has been a great year for both equities and fixed income. For the first time in quite some time, believe it or not, international equities are leading the way. Through the end of November, one of your international equity portfolios was up almost 30% on the year. You look at small cap equities. They've been a very big beneficiary from the Federal Reserve cutting rates 3 times. Look at small caps that are trading near all-time highs today. And then you look at large cap equities here in the U.S. They've been what's driven the performance of this portfolio for the better part of the last decade. And what we're seeing right now is it's on pace for the 3rd consecutive year of double-digit returns. Now, if you switch over to fixed income, how we manage it at CS McKee, we're very traditional in the sense that we want it to be the anchor of your portfolio or the counterweight to the riskier assets that you hold. And one of the biggest beneficiaries for that portion of the portfolio has been the Fed normalizing rates. So through the end of November, that portfolio has been up almost 8%. Now, what we have seen as we've moved into the 4th quarter, we have seen more volatility that's crept back into the markets. To start off in October, we had the government shutdown, which, as we all know, it ended up being the longest shutdown in history. And then from there, we moved into November, where investors became very uneasy with a lot of the artificial intelligence and the big tech valuations. And one of the things that was most concerning for investors has been the investments that companies are putting back into AI. Now, to give you an example, if you look, Amazon, Alphabet, Meta, and Oracle collectively, from September through November, issued $90 billion worth of bonds to fund their AI infrastructure build-out. And to put that into perspective, they haven't issued that much money in bonds in the last 40 months combined. And so what we're seeing right now is you're starting to see investors question, could this potentially be, with all this money flowing into AI, be the next dot-com bubble? And so what we saw in November, we saw almost a 5% pullback in the equity markets. But what's been interesting is that was nothing more than a blip on the radar. From there, we've not only seen them recover the losses, but the markets in this portfolio has moved higher. So you look through the end of the end of November, the portfolio has a market value now north of $15 million and about $245 million. So it truly has been a fantastic year. As we go into next year, one of the things that we think can be a tailwind for the portfolio is the continued lowering of interest rates, as well as tax cuts, and this AI boom. The expectation is that it is going to continue. There are a couple things, though, that we want to keep a close eye on. Number one's the labor market. If you look at the labor market, some of the numbers came out yesterday. The unemployment rate is now 4.6%. That's the highest that we've seen in 4 years. And what we're seeing right now is hiring is definitely starting to slow. On the flip side, when you look at the economy, we've talked about it in the past. We as consumers, we account for almost 70% of the economic growth here in the United States. It's our spending. And when you look at the economy right now, it's divided. On one side, what you have is you have the higher income earners right now that are benefiting from the stock market trading near all-time highs. So it's been their spending right now that is driving the economy. On the flip side, when you look at the lower and middle income classes, they're being very cautious and being very wary with their spending. And rightfully so. When you look at it, the cost for many of the everyday goods that we buy today is about 25% higher than where it was back in 2020. And over the last few years, the middle income classes, they've been able to brush that aside because of the savings that they built up. You go back to 2020, those savings were almost $500 billion on the backs of things like stimulus and child tax credits. But those savings now, they've been wiped away by these higher prices. And so it's definitely going to be something to keep a close eye on as we go into 2026. Some of the initial numbers coming out just with spending over the Black Friday holiday weekend. Surprisingly, it's coming better than expected. Spending was up about 4.1% from where it was the year prior. But when you break it down, there's really two areas that did very well. Number one was the more luxury, high-priced items. Believe it or not, they were up 21% from the prior year. And then on the flip side, what we're seeing is a lot of the more bargain hunters. And what we're seeing they're doing right now is they're trading in their everyday spending on things like haircuts or casual lunches or even maybe buying a higher-priced razor. And instead, they're using that to buy gifts for their families and friends, clothing, toys, other seasonal items. And so it's definitely going to be something that we want to keep an eye on going into next year. And again, it's going to be that consumer spending in the labor market that's going to determine whether this bull market continues or we see a pullback. Zach, you want to?
Yeah, I'd be happy to provide a few more comments, and thank you so much for having me. It's an honor. Is this on? Can you hear me? Can you hear me now? Okay, there we go. It's an honor to be here for the first time. Funny story, Shane actually was trying to get me to come to CS McKee for a little over a year, and I was thinking about it, considering it, and it took one phone call with Mark Ensheimer and one meeting with Mark Ensheimer. I said, "All right, let's do this." This was his favorite place to come visit. I've heard a lot about all of you from Mark and Shane. The one thing that I might disagree with you on is I somehow got convinced by my wife to go to King of Prussia Mall on Black Friday, so I was not surprised with the chaos there, with how many people were there spending money from the consumer. But really, just to build off of what Shane had said, I think when we look at the markets for 2025 as a whole, the first 6 months, the markets were really driven by a lot of the tariff conversation. That was very new to us. A lot of us as investors, trying to figure out how is that going to have the trickle-down effect to markets broadly. The third quarter was much different. Shane hit on this, but the two main themes, again, were AI spending and interest rate cuts. And AI, we're not here to say that it's definitely going to be transformative of how we work, how we live, but there are so many risks that are baked into it currently. The Mag 7 alone, and you brought up some of those names, but really the 7 largest companies in the U.S. public stock market, they're estimated to spend almost $380 billion on artificial intelligence in this year alone. That's what some of the estimates are at. So just unprecedented spending for this. It blows away anything that we saw even during the internet rise in the late 90s. So that's something we're paying close attention to. There's going to be a lot of opportunity in that space, but There's some studies out there, the Massachusetts Institute of Technology, they put out a study that said that they believe 95% of all AI investments so far have seen return on investments of zero, right? There's going to be a lot of winners, but there's going to be a lot of losers as well when it comes to artificial intelligence. But it is something that is likely here to stay. It does create some risks in the market, and we're paying close attention to that. The second theme, like we said, interest rate cuts. There was that sort of a tug of war. Is this going to happen this year? A lot of people believed it should have happened earlier. A lot of people say we're not ready. And you look at the Federal Reserve historically, markets were going up so far this year. Labor market was pretty strong, and inflation was not anywhere near the 2% target that the Federal Reserve has laid out. However, in July, the Bureau of Labor Statistics, they revised their jobs report downwards by over 900,000 jobs. At that point, the Federal Reserve had to say, it's time, we're going to start cutting. And despite, if you paid attention the last 5 years to what's going on in the markets, headlines were dominated by inflation. And that is an important piece of what the Federal Reserve does. But they have a dual mandate, so they're responsible for inflation as well as keeping employment as full as it possibly can to stimulate the economy. So once that news broke, it was almost a foregone conclusion they were going to start cutting rates. And September was the first one? September was the first. There was 2 more that came down the line. And both of those, artificial intelligence or any type of spending back into companies, that's going to be a tailwind for these companies. Wall Street loves to hear that they're investing back in their company. And then same thing with Federal Reserve. Whether you're a consumer, whether you're a business, lower interest rates, that will likely push or make people more open to borrowing money to maybe hire more, to put back in their businesses. So both of these were strong tailwinds that got us to this point where we really have had 3 really strong years in a row when it comes to the equity markets. We bring up those 2 things. I don't think those 2 themes are going away. I think that's going to drive most of what the markets are going to tell, or the story that's going to be told next year as well. Shane hit the nail on the head. The labor market, you're starting to see some cracks. That's going to be very telling of the decisions the Federal Reserve makes moving forward. The term that I heard that I really like, we're kind of in this no fire, zero hire environment. It's a really weird sticking point. That we haven't seen mass layoffs or mass firings, but we're not seeing this, wide, excitement to bring on new employees to the workforce. So those 2 things, we've both talked about them today. I'd imagine next quarter you're going to hear an update about where things stand with those 2 as well. The other thing, Shane, do you want to talk about the portfolio changes at all? Or?
If you want to touch on those, that's good.
Yeah, so I wasn't here at the last meeting, but I think there were some changes to the portfolio. We did have a large cap core equity holding, which was one large cap U.S. equity strategy that we split into 2. So instead of having one strategy, we now have a large cap growth strategy and a large cap value strategy. A number of benefits there: increased diversification, our ability to maybe, if we see opportunity in one versus the other, we're able to make those changes much easier. And the other thing is, we do have a new value equity team enhancing our investment capabilities. And if you look at the numbers, the large cap value, they've had an unbelievable run, and they've done extremely well over the last few years, including since the change was made for your portfolio specifically. So that's something we're really excited about to have. We think we really strengthened your portfolio, made it more diversified, but also protect to any downside risk, having that true value exposure. And the numbers tell themselves. We're taking part in the upside returns as well.
One of the things that I did want to point out with it, especially with these county pension funds, that 5-year number for the smoothing is very important. If you look through the end of the 3rd quarter, your portfolio for that 5-year period returned 10.71% versus the benchmark that was up about 9.3%. So it truly has been a fantastic 5-year period. And keep in mind, that also includes 2022, which was the worst year on record for balanced funds, with both equities and fixed income losing money. So it's been a great run here. Our hope is that it can continue here into 2026. Be happy to pause there, take any questions that you have.
How do you think 2026 is going to go? I don't know if you mentioned that.
Yeah, I think as you look out in the 2026 right now, I think one of the big tailwinds for stocks that could potentially help, it's going to be the lower rates. The Fed's cut rates, as Zach and I have both said 3 times so far this year. The expectation is we'll get at least another 1 or 2 next year. So that's going to be a big boost for the economy. The other thing is tax cuts. The expectation with these corporations that are receiving these tax cuts, they're going to invest a lot of that money back into their companies, whether it's through hiring or whether it's through things like artificial intelligence. And as Zach said, I know there's been times where there's been some concern with the artificial intelligence and where valuations are, but it doesn't seem like that's going to slow down anytime soon. So as long as that continues, we could potentially have a pretty good year in 2026. The big question is going to be the consumer. Do we see this unemployment rate continue to creep higher, and does the consumer continue to spend money? As long as those 2 things happen, that they continue to spend money and the unemployment rate kind of plateaus and levels off, there's no reason why that we can't continue this run. But what you'll see with this, especially after this 5-year period, we will take a more cautious approach with it going into the year and see how things settle before we take on too much risk with the portfolio. We always want to be more conservative with this portfolio.
Do you think that in looking into late 2026, do you foresee any significant job losses as a result of AI as we get late in the year?
At this point, we don't. We think that's more down the road with AI and what is coming. What's interesting, we talked about this. I was at a conference in November and called a restaurant to make a reservation. It was the first time where you actually had AI that took my reservation and let me know if they had availability and what the seats were and where the options were. We're not expecting anything major in 2026, but I think as you look out 5 to 7 years down the road, that's potentially when we could see it.
There's a ton of excitement around AI right now, and we kind of joke about it all the time. Companies that have nothing to do with technology, they can get on their earnings calls and talk about how they're spending in artificial intelligence, watch their stock jump 5%, right? And there's not even a tech, they could make chairs or tables, and everybody wants to talk about what their capabilities are. In 2026, I think that's going to be an interesting story to see if that continues, because you're seeing a lot of non-earning, unprofitable companies do very well this year based on what they should be able to accomplish through AI. And at a certain point, when you're putting this type of money into something like that, making that type of investment, you have to see the bottom line return. Investors, companies, consumers, they have to start seeing return. So we're watching closely on that. And even NVIDIA, right? NVIDIA is the stock of 2020 so far, and it's amazing what they can do. But if you listen to their earnings report, if they meet their earnings, what they're expected to do, they usually fall. If they don't blow their expectations out of the water, they're typically going to dip that day. So it's almost like it's like an uneven scale right now. And I think in 2026, hopefully a lot of that kind of calms down, and we get a true sense of what are the impacts down the road and how does this impact markets.
That's it? Anything else you want to add? Nothing else?
That's it. Thank you all.
It's all good stuff. It's all
Just-
great news. So,
one-
well, hearing
one-
all that. Oh, go ahead.
One little thing. Could we, in the report, just something that I don't know if anybody else likes these little things, in the year-to-date, quarter-to-date, can we do a comparison of previous quarter-to-date and current quarter-to-date? That is how June 30th compared to September 30th? Just to look at the steps that we're taking, little steps that,
Absolutely.
just one more column.
Yeah, absolutely. And what we can do with it too is we can include those pages just side by side so you can see everything.
Good, thank you.
All right. Well, would somebody like to make a motion to approve the performance report?
So moved.
Second.
On the question? All in favor?
Aye.
Thank you. All right, well, that was quick and easy. Now you gotta drive back to Pittsburgh?
Back to Pittsburgh.
No, I know that. I'm just. Yeah, we have the public, anybody from the public, nobody's here. But I'm sure they're all watching on ECTV, so they're all watching. Anybody, would anybody else like to add anything before we adjourn? Anybody want to make a motion to adjourn?
I'll make the motion.
Second. On the question on that? All in favor? Aye.
Aye.
Thank you. We're adjourned. Thanks, guys.